Federal Reserve is starting to raise interest rates in March, and the sell-side strategists are saying they'll raise short-term rates 5, no, it's 6, 7, nope, 8 times this year to combat inflation. How do we know? Well, the Fed funds futures are telling us so, per economists and TV personalities on CNBC. Hey, I'm Chris Parrish, Chief Investment Officer with El-Erian Financial Group, and this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise? Before we continue, please take a moment to hit that subscribe button and the notification bell so that you will be notified when we upload new content. Viewers, inflation is continuing to trend higher than I expected, with the current culprit being Russia's attack and invasion of southern Europe's Ukraine, driving up already elevated oil prices and grain prices as well. My prayers go out to families on both sides of the border who've been brought into this event by powers beyond their control. Viewers, this discussion is focused on the constant TV rhetoric about the Federal Reserve's path for raising interest rates and forecasting ability, often quoted by the Fed funds futures market. To be brief, these forecasts, based on where the Fed funds futures markets are trading, are historically of no help to investors in predicting future interest rates. One need to look no further than real-time trading markets for Treasury bonds, which in the last 7 to 10 days have pushed these odds from 7 to 8 raises back to 4 or 5. In a few days, one can blame the flight to quality that has transpired since Russia invaded Ukraine, or you can blame Chairman Powell and his recent public comments of planning on raising short-term rates by 25 basis points in March and then being measured each meeting thereafter. Either way, the last 10 trading days should prove those watching TV that the forecasting ability of this data series is total garbage. As longtime Keep Your Connected to Your Money listeners know, this is what my own personal research has said about this data for years. If you don't believe me and my word, here's some hard academic research from Ken Peterson of Laffer Associates, founded by Arthur Laffer, entitled Predicting the Fed. The following is quoted from their research abstract, and I quote, "Is predicting the Fed funds futures and beating the Fed funds futures market mission impossible? Not so. Their model, which only used historic data, was better predictive and better able to explain future monetary policy by the Fed than a forward-looking measure like the Fed funds futures rate. The fact that the Fed funds future market can be beaten by a statistical model suggests the Fed funds futures market lacks efficiency. The trading financial markets allocate too much weight to current Federal Reserve communications and other real-time macro events and allocate too little weight to past monetary policy behavior." What's that mean in layman's terms, in investors' terms? It means this: turn off your TV when Steve Leisman, El-Erian, or others on CNBC quote this meaningless statistic. The data says the Fed is a creature of habit, behavioral finance works, history repeats, the trend is your friend, and outside economists and traders know almost nothing about the Fed funds future path beyond a few weeks. It means stay away from trading this market, and outside of entertainment, you can generally disregard this often quoted real-time data regardless of how smart it might sound. And viewers, feel free to give us a call here to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Give us a call here at El-Erian at 877-896-0040. We're here to help you on your financial journey into and throughout your retirement years. I'm Chris Parrish, and have a great week.